Ever wondered how interest rates affect your daily life? Well, let's dive into it. Interest rates, quite simply, are the backbone of our financial and economic systems. They touch almost every aspect of our lives, from our personal savings to the global market. So what are interest rates really? They are the cost of borrowing money, or alternatively, the reward for saving it. Let's break that down. Say you've got some extra money lying around. Lucky you! You decide to deposit it in a bank. In return for using your money, the bank pays you interest. On the flip side, if you borrow money, you pay interest to the lender. Now, how do we quantify this? Interest rates are usually expressed as a percentage. Picture this. You borrow $100 at a 5% annual interest rate. After a year, you owe $105. On the contrary, if you save $100 in a bank account at a 3% annual interest rate, you would earn $3 in a year. Not a bad deal, right? But let's not forget the significant role of central banks, like the Federal Reserve in the US. They set benchmark interest rates that influence the rates banks charge each other and consumers. These rates can impact a myriad of things, from the cost of mortgages to the return on savings accounts, and even the interest rates on your credit cards and loans. And if you're wondering how the economy fits into this, well, the level of interest rates often mirrors the economy's health. In a robust economy, interest rates are typically higher to prevent overheating and inflation. In a weaker economy, lower interest rates can stimulate spending and investment. So, in a nutshell, interest rates are the cost you pay for borrowing money, or the reward you receive for saving money. And as we'll explore in the following scenes, they play a crucial role in everything from international finance to investment decisions. So, stay tuned. Now, who decides these interest rates and how do they impact you? Enter the central banks, the puppet masters of the financial world. Central banks, like the Federal Reserve in the United States, have the power to set benchmark interest rates. These rates are a sort of financial barometer, influencing the rates that banks charge each other for short-term loans. But the reach of these rates extends far beyond the walls of financial institutions. They impact you, me, and everyone else who interacts with the financial system. How? Well, these benchmark rates indirectly influence the interest rates that you and I encounter in our daily lives. When you go to take out a mortgage to buy a house, or when you deposit your hard-earned money into a savings account, the interest rates you're offered are influenced by the rates set by the central bank. Let's delve a little deeper. Suppose you're applying for a home loan. The interest rate you're offered on your mortgage isn't plucked out of thin air. It's influenced by the benchmark rate set by the central bank. When the central bank raises its rate, banks usually follow suit, hiking their own lending rates. This means your mortgage could become more expensive. The same goes for savings accounts. If the central bank lowers its rate, banks typically lower the interest they pay on savings accounts. So if you've been diligently saving and expecting a certain return on your savings, a rate cut could mean you earn less than you anticipated. And let's not forget about credit cards. Just like with mortgages and savings accounts, the interest you pay on your credit card balance is influenced by the central bank's benchmark rate. When this rate goes up, so does your credit card interest rate. This means your outstanding balance could cost you more in interest. So you see, the central bank's benchmark interest rate isn't just a number for bankers and economists. It's a number that affects how much you pay on your mortgage, how much you earn on your savings, and how much you're charged on your credit card debt. Therefore, the interest rates set by central banks have a wide-reaching impact on your financial life. How do interest rates reflect the economy's health? This is a question that often arises in financial discussions. The level of interest rates, in fact, mirrors the state of the economy quite closely. In a robust, booming economy, you'll typically see higher interest rates. Why is that? Well, as businesses expand and consumers spend, the demand for money increases. This growth can lead to inflation and overall rise in prices. To prevent the economy from overheating and to keep inflation in check, central banks raise interest rates. Higher interest rates make borrowing more expensive, which can cool down economic activity. On the flip side, in a weaker or slowing economy, lower interest rates are often in play. This is because lower interest rates can stimulate spending and investment. Here's how it works. When borrowing costs are low, businesses are more likely to take out loans to invest in new projects, and consumers are more inclined to make large purchases like homes or cars. All this spending can help to stimulate the economy. Central banks use interest rates as a tool to manage these economic cycles. In times of economic downturns, they may cut interest rates to encourage borrowing and spending, thereby giving the economy a bit of a boost. Conversely, if the economy is growing too fast and there's a risk of inflation, central banks can step in and hike interest rates to help cool down economic activity. This dance between interest rates and economic health is a constant balancing act. It's about stimulating growth when needed, but not so much that it leads to inflation. And it's about cooling growth when necessary, but not so much that it leads to a recession. So whether you're a business owner considering a loan for a new factory, a family deciding whether to buy a house, or an investor looking at bond yields, understanding how interest rates reflect and influence the economy's health can be incredibly beneficial. So, interest rates serve as a key tool for managing economic growth and stability. They are the levers central banks pull to steer the economic ship, helping to keep it on course through calm and stormy weather alike. But what about on a global scale? How do interest rates play a role in international finance? Well, let's dive into the nitty-gritty of it. Just as interest rates are pivotal within the domestic economy, they also play a significant role on the international stage. Picture this: countries with higher interest rates often become more attractive to foreign investors. Why, you ask? Well, it's quite simple. Higher interest rates mean higher returns on investments. So, foreign investors are more inclined to invest their money in countries where they can get a better bang for their buck, so to speak. As a result, these countries often see an influx of foreign capital. This flood of foreign investment can lead to a stronger currency. Essentially, as demand for a country's currency increases, so does its value on the international market. But, as with all things in finance, it's not all sunshine and roses. A stronger currency can also mean more expensive exports. Here's how it works. As a country's currency strengthens, its goods and services become more costly to foreign buyers. This can lead to a decrease in exports and in turn affect the country's trade balance. Now, the trade balance is the difference between a country's exports and its imports. When a country exports more than it imports, it has a trade surplus. But when it imports more than it exports, it has a trade deficit. A strong currency can tip the scales towards a trade deficit, as it makes the country's exports more expensive and its imports cheaper. So, as you can see, interest rates are a bit of a double-edged sword in international finance. On one hand, they can attract foreign capital and strengthen a country's currency. On the other hand, they can make exports more expensive and impact the trade balance. All in all, it's a delicate balancing act that requires careful management and a keen understanding of international financial dynamics. Clearly, interest rates have a significant role in shaping global financial dynamics. So what does this mean for your investment decisions? Well, interest rates play a pivotal role in shaping your investment strategy. When you're investing, you're essentially comparing the interest rate you can get on safe investments, such as government bonds, to the potential returns of riskier investments like stocks. Let's break it down. When interest rates are low, the returns on safer investments like bonds decrease. This often leads investors to seek higher returns in the stock market, which can drive up stock prices. Conversely, when interest rates rise, bonds can become more attractive as they offer a safer return compared to the volatile stock market. It's a balancing act, really. A keen understanding of interest rates, how they fluctuate, and the reasons behind these movements can give you a competitive edge in making informed investment decisions. Therefore, keeping an eye on interest rates is crucial for making smart investment decisions. So, how do we summarize the importance of understanding interest rates? Interest rates are a fundamental pillar of our financial and economic systems, influencing everything from your personal bank account to global economic trends. They are the cost of borrowing money and the reward for saving it. Central banks set benchmark interest rates, impacting everything from mortgage costs to the return on savings accounts and the interest rates on loans and credit cards. These rates also reflect the health of our economy. Higher rates often indicate a strong economy, while lower rates can signal a need for economic stimulation. On a global scale, countries with higher interest rates often attract more foreign capital, strengthening their currency. And let's not forget the critical role of interest rates in investment decisions. Remember, understanding interest rates is not just for economists or investors, it's for anyone who wants to make informed financial decisions and understand the broader economy.